Hello and welcome to Money Control. I am Santosh Nair in conversation with Udayan Mukherjee, Consulting Editor, CNBC TV 18. Good morning, Udayan. Good to have you here with us. So we did see a fair bit of recovery in the market last week. So is the worst over?
Hi Santosh. I wish one could say that the worst was over for the market, but somehow I feel that it may not be. I would agree that a large part of the price damage in mid caps and small caps might be over because it started well before the Nifty fell. The Nifty only started falling from its recent high of 11,800 about a month or so back. But if you look at the performance of the broader market, which is mid caps, small caps, the broader universe of 4,000-5,000 stocks, there the damage had actually started happening much earlier in the year, as early as around the budget time, and after that I think the serious damage started then. So in a sense, the broader market, bear market, is probably more than 6 months old right now, while the Nifty has started its serious leg of the downside maybe just about 4 or 5 weeks back. So keeping that in perspective, I would say that a large part of the price damage in many mid caps and small caps is probably mostly done. You cannot say it's all done at any point. That would be picking a bottom, which none of us are qualified to do. But I would say that a very large part, maybe 75-80% of the price damage is done. However, bear markets, which we are in, are very cruel. Sometimes they'll give you a pullback rally and you'll think that we have bounced off a bottom, but it will inevitably go back and test that bottom, pierce that bottom, and then sometimes there are these climactic bottoming sellouts which flushes out the last bit of the price correction, and that is very, very painful, and I don't think that has happened yet. So my sense is that we have hit some kind of an intermediate bottom at around the 10,200 level on the Nifty. That might hold for some time, I hope. We'll have pullback rallies from there, maybe even smart pullback rallies, some mean reversion, and then there will be some other news trigger over the next few months which will take us back to those kind of levels and maybe even slightly lower levels from there. So I'm not predicting that we've hit a bottom, but there is going to be a painful process from here on. But just in the near term, we could be looking at some kind of consolidation using that 10,200 as an anchor or base.
So Udayan, what is your sense of the macro picture? The inflation, retail inflation and IIP data announced on Friday were also not all that comforting. So how do you see things playing out on that front?
Our bigger problem is macro, Santosh. Right now, the market is not very focused on micro either. There are telltale signs. You look at the market's reactions to results of the first few results, big results which have come out like TCS and HUL. TCS was an acceptable set of numbers, I thought. Small wrinkles here or there. Stock has corrected. HUL, 10% volume growth. At another time, the market should have been very happy. Stock is correcting. That is telling you, or that is the market's way of telling you, that a large part of the good news was already in the price, and therefore even good news is not able to take stocks higher. On the other hand, the market is also telling you that valuations in many pockets like consumers, HUL, etc. were quite excessive, and therefore in the new regime that the market finds itself in, which is frankly a bearish regime, P multiples are prone to contraction, and therefore expensive stocks are seeing their P multiples contracting. Case in point, HUL, Avenue Supermarts, etc., where stocks have come off post results. So I think the general feeling in the market is that right now the macro concerns surrounding the street are leading to some kind of a PE derating, which is a stronger impulse than any kind of an up move in the price tracking earnings improvements. Even 3 or 4 months back, I would have said the market was completely focused on earnings and earnings recovery. And wherever it was convinced that earnings recovery was on track, stock prices were going higher. But that micro focus is now replaced by a far more macro and global focus. And therefore, I think that has become the far more dominating impulse in the market. So macro, I think, is overruling the micro for the moment, and that probably is going to be the hallmark of this bearish phase that we are going through.
So how does one look at stocks like TCS and HUL right now?
Well, chalk and cheese, because TCS is benefiting enormously from the tailwinds of the currency depreciation. If the rupee forms a new low below 74 and continues its downward drift, even after a pause, you will see that IT is the sector which will benefit. The problem with TCS is not its performance. It's a class act. We all know that. The problem is that valuations probably had run up too much over the last 6 months or so, ever since the rupee started falling. and now it's trading at about 20 times 2020 earnings, which is 1.5 years forward. If you look at 1 year forward, I think the P multiple is closer to 22 or 23, which is about the highest that TCS has traded at in its trading history. And therefore, the reluctance on the part of investors to add more of TCS at these kind of valuation levels. So I would say TCS's problem is not its performance. It is still guiding to double-digit growth this year. The management is excellent, and therefore it's a question of just averaging out or sort of stretching out the valuation a little bit, allowing earnings to catch up. So I don't see a massive fall in the TCS stock, maybe just consolidation, allowing for valuations to temper off. HUL is a different kettle of fish. While volume growth is picking up, and that's very, very strong and good for the stock, margins, there are some issues out there with the margins. A, because of some kind of voluntary sacrifices on pricing. More importantly, because of the way crude and the rupee has behaved, which affects HUL margins. And the street is concerned that profitability, even despite or given a strong volume growth, might still be a little lackluster. The bigger problem, of course, is that the stock is trading at 50 times 2020 earnings. And in the current bearish framework of the market, it requires a lot of courage to go out in anything which is trading at about 50 PE.
And what do you think about NBFCs? These stocks also saw some bit of recovery last week. Is it time to bottom fish out there?
No, NBFCs have a long road ahead of them, Santosh, I'm afraid. The price damage has been intense, and you cannot say that one should be as cautious or bearish about NBFCs as one would have been 3 or 4 months back, because a serious amount of price adjustment has happened, reflecting some of the new realities of the sector. But even so, why would you buy NBFCs right now, given that you know that their overall loan growth trajectory is going to come down, their margins will be under pressure because of the higher funding costs, and generally liquidity is very, very tight. So I think what will happen right now is, once you get any bounce backs, as you saw last week in NBFCs, people may use some of these NBFC bounce backs to shift away to some of the private sector banks, saying that maybe in the next 1 or 2 years, banks will get back some of the market share that they lost from NBFCs, because NBFCs are beset with problems of their own. And therefore, it might be better value to pick some of the private sector banks rather than go after NBFCs. So pullback rallies, yes, but is the pain over for NBFC as a sector? I don't think so. And I also feel that they remain an overbought sector, over-owned sector, because all of the ownership which got piled up over the last couple of years when the stocks were the heroes in the market has not got corrected. I think people are frozen by the fall in NBFCs, frankly, and therefore any up moves in the sector will be used by people who are stuck with these stocks to liquidate, and therefore there will be a constant supply of NBFC stock coming into the market. So I think there will be pullback rallies, but I don't think the pain is over.
What are your thoughts on oil marketing companies? Now, these two have been falling for quite some time now.
Well, it depends a bit on crude, and it's unfortunate that what's going on in Saudi Arabia now has led to the crude price hardening once again back to about $82, because it looked like crude had started a downward spiral, at least for the moment, from 86 to 80 and maybe even below that. But it took support around 80 and has bounced back. And the moment crude bounces back, crude is such an important and emotive part of the market right now. Every time it bounces back, all the crude sensitives, as we know, they start tanking, whether it's oil marketing or aviation and all of these names. I think one other thing has happened, which is that the faith in the market on fuel deregulation as an anchor has got shaken by the government's move last week or 10 days back, asking oil marketing companies to bear part of the burden. That was not part of the deal. That was frankly a very, very silly move on the part of the government to do, and you could see that enormous erosion in public wealth and the market value of these oil companies, several times more than what the government expected to make by asking them to share this burden. So I think once you have a contract with the market that I am deregulating the sector, and then when things go a little difficult, you start going back on your word, then people lose confidence. They start asking that at $85 you're doing this, so what if crude goes to $100 next? What will you do with the oil marketing companies which you own? And that fear, I think, will stop any of these oil companies from rallying beyond a point. The rally was a pullback rally because they had fallen very, very hard last week, early part of last week, and you will get these in oversold sectors. But I think confidence is shaken and crude is still not out of the woods, and the two are a very deadly combination for oil companies now.
Now, interestingly, inflows into mutual funds continue to be steady, at least as far as the SIPs are concerned. We saw about a little over 7,000 crore coming in September. Do you see any change on that front in the near future?
Well, October will be interesting to see because the big fall happened in September. So let's see what the October flows have been like, which will come out at the end of this month, and they will be very important because the big correction happened in September. So I'll be watching this month's numbers very, very closely. Now, there are two ways to look at this, Santosh. You could, on one hand, correctly say that the retail crowd has not got rattled yet by such a big correction, and that is a departure from how investors have behaved in India in the past, which is such a welcome sign that they're staying the course. They're saying, perhaps saying, or maybe I speak too soon, that I will hold through cycles, I will not panic. And if that is the case, then I think this market will probably not go down to the kind of levels which ordinarily a bear market would take our market down to, because it is a big rock of resilience. The other way to look at it, which is probably an uncharitable way, is to say in September you still had 7,000 crores coming in from domestic sources and the market came down 1600 points on the Nifty. So what would happen if the domestic money deserted the market for a month or two? What would happen if those flows dried up? And I shudder to think, given the kind of imbalance we have in the market between supply and demand of stock, what would happen if domestic flows were to dry up? So all we can do is to keep fingers crossed and hope that the Indian investor has sort of grown up and is going to behave more maturely or equally maturely going forward, because if for some reason they blink, then probably you've had it for this market.
Well, Udayan, thank you for sharing those insights with us.